Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. We're back for another episode. Josh, how's your week been, buddy?
Yeah, Steve, it's good. It's always good. We're approaching Christmas very, very quickly. I'm not sure what do I do? I've got a young child that's just going to be born. Do I buy the child presents at that age, Steve, when they're a month old, or
I think you're supposed to
no?
wait till they're born, but
Yeah,
you
no,
know,
after they're born, but
yeah.
be a month old. So I don't know if you buy presents at that point, do you?
Look, you start spending a lot of money. Let's be
Yeah,
honest,
great.
you have kids, so go for it.
So that's what I'm looking down the barrel of. But yeah, there's obviously lots going on markets-wise as well. But the hot one
Yep.
is really interest rates at the moment.
Yeah,
There's a lot of talks, and the markets are actually pricing in that interest rates that could be cut before the end of the year, which I don't know if that will happen,
yeah.
but the markets are pricing in two possible rate cuts before the end of the year, which hey, I'll take it. I'm all for that. But I don't know. I feel like if I was putting money on it, I'd probably say the first quarter. But who knows? It all changes very rapidly at any point in time. And geez, you've got a lot of just tension in the world at the moment. You've got the US election coming up. Who knows how that thing plays out? You've still got Ukraine and Russia, and then the Middle East is, God, that's not looking good.
No,
What's happening there, and that just continues to heat up. So there's definitely a lot of headwinds
yeah.
out there. But mind you, the markets are sort of holding up there and remaining pretty stable. So all in all, keeping us busy as usual. What's happening on your end?
Mate, I'm back in Adelaide today. I was in Melbourne this week. We took the team out, which was great. We've had a big Q3, looking for a big Q4 to help more clients out there. So things are busy. Before we know, it'll be Christmas and we start again 2025. So it's going to come around real quick here.
Yes, indeed.
We rip into today's topic, mate, and it's all about family trusts. And we take a deep dive into family trusts, how they work, how they operate, and the benefits and what we can do with them. We've spoken about this a couple of times, but I think we can go a bit deeper on this one. What's your take on it, mate? Family trusts, who are they for? How can we use them? And what do they do?
Yeah, well, family trust, it's just pretty simply a separate entity. It's basically what it is to you as an individual. And there's a bit of fuss around them, and people think that they need a family trust. It sounds cool to have a family trust, but the reality is they're not for a mass majority of people out there in Australia that can actually benefit from them. And the reasons why people typically will look towards a family trust is for two main reasons. One, everyone usually goes tax minimization. Everyone wants to, reduce tax, pay less tax to the government. Who doesn't? That's normally the main motivator and primary motivator. But there's also another big reason for it, which is asset protection, which is why a lot of business owners also look at utilizing a trust structure. And that's why, for business owners, it's generally going to be a bit of a no-brainer to operate and have your company owned through a family trust structure, which we can unpack. But it can still be beneficial for employees as well. Just got to have the right circumstances and doing the right things. But really, it's just another structure that you can invest through. And we always talk about the different structures out there that you can invest through. And part of our role as an advisor is when we see someone is to look at all those different entities and structures. And if we talk what they are, you got family trust, you got a regular company that you can invest through. You could invest through an investment bond, your individual name, your spouse's name, joint names, or it could also be through your superannuation or a self-managed super fund. So there's obviously a lot of options out there. And then it's actually just about figuring out what's the right one for you. And they all have different tax rates, nuances, flexibilities, can do this, can't do that. So there's no sort of clear cut solution for anyone, and that's obviously a big part of our role is to figure that out ultimately for clients. But we both have family trust, Steve. So what's been your experience? And I suppose why did you originally even set up a trust in the beginning? Why'd you do it for yourself?
Yeah, well, I'd say this. Look, trusts in general are just holding entities, right? They're holding assets for other people or persons.
Yeah.
That's what they do.
Yep.
To simplify, that's all. It's like a person. Treat it like a person. It's an
Yep.
entity. If we get specific with it, it is a discretionary trust. But if you think of it just like an entity or a person holding onto assets for someone else, that's what it does. And effectively, what it allows you to do is attach different people to that trust to receive the benefits of it. So,
Yep.
in simple terms, you can have any asset you want in there. in the family trust, owned by the family trust, and then you can then siphon off the benefits of that family trust, be it mostly income generally, or cap gains, or whatever it may be, down to different beneficiaries as you see fit. And that's the major benefit of it. So I personally have a family trust. It holds my business assets. It holds shares. It holds different types of assets. It doesn't hold property at this stage, but one day it might. And it's very beneficial for that reason, because it allows me to decide who per year is going to receive those different incomes across the journey, and that can change year to year, and that's the beauty of them. That's the major benefit of it. Simply as that. We can talk about asset protection. We can talk about other benefits, but really it's about you can decide who gets that income per year to pay less tax.
Yeah. And it's just flexibility, like you said. They commonly referred to as people say family trust, but that means a discretionary trust. There's also another trust called a unit trust, which we can lightly sort of touch on, but they're not as common. You don't see too many unit trusts out there. But yeah, the big part is just that flexibility. And if you use a simple example, say you have a business owner, like why would they end up using a family trust? Say they're got a business and it's quite profitable, and you're paying yourself out $300,000 or $400,000 a year. You could pay that all out to yourself as a wage quite easily, or you could be looking at paying that out through dividends, and maybe your spouse is not working or working and paying less, in a lower tax bracket, and therefore you can then get the benefit of you earn your 400, but then it goes out through your trust as a dividend, or a portion of it at least does. So you might cap your total earnings at a maximum of say 200 or close to it, and then distribute the rest through the family trust, possibly through to your spouse, other beneficiaries. And it's probably worth noting who can be beneficiaries of a family trust, which is nearly anyone. The really important part of that is your trust deeds wording. So if you talk about the actual setup of it, there's a very important document called a trust deed, which is basically then going to govern how your trust is run on the year-to-year basis, I suppose. And in that trust deed, it will make note and mention who can basically be beneficiaries of the family trust, which is generally worded in a way that nearly anyone. So, yourself, your spouse, your kids, family associates, grandparents, whatever it may be, parents, etc. So it can be quite broad. It can also be other entities, and this is where you can kind of start to get a little bit complex. It's something I've done in the last financial year, is actually look at having an actual separate company as a beneficiary through the family trust. And you go, hang on, what's happening there? Because there's all these different other moving parts. Like there is a company being Link Wealth Group. There's a trustee company, which is the holding company at the top of the trust. And now there's another company as a beneficiary. So there's all these moving parts in all these different companies. And obviously that comes with costs as well with doing that. But for certain situations, that can actually be very, very beneficial. But yeah, all you're really getting there is that flexibility. That's what you're paying for, to manage and change it year to year. And particularly longer term, when you start offloading assets, you have a ton of flexibility in relation to it. But what if we touch on like costs, time to set up and things like that, Steve? Like what's your just guide around that?
Yeah, time to set up. Look, you're probably a couple of weeks, start to finish. They can be done actually relatively quickly. I think that the tougher part's dealing with the registrations, ATO, and the like. That takes a bit of time, but the trust itself, it can be done within a couple of days, because it's just a trust deed, really, piece of paper, a bunch of documents. And then it's really about setting up the bank accounts within the trust, or the investments in the trust, and that's really the time it takes. There's a bit of KYC, know your client stuff you got to go through, and anti-terrorism stuff you got to go through, but relatively quickly. Then from a cost perspective, look, you're probably looking at $2,500 to set up a trust with the general accountant, I'd suggest. Can give or take, it can vary. And then that's your setup cost. And then per year, you're looking at your annual financials and tax returns. And again, depending on which accountant you go to, probably around $2,000 to $2,500 per year. So the benefits have to far outweigh the cost, obviously. You don't want to be paying $2,500 a year if you're not going to get the benefit. So that probably leads us on to the next question, is who's it beneficial for? And when should you do a family trust? Because there is a tipping point with this stuff. And part of our job is, whenever we look at tax structures and entities to invest in, we've got to make a decision on obviously which structure we're going to use. And I'll say this, that whenever I give advice, and I know you do too, we use probably 3 or 4 different tax structures in every piece of advice. So it might be a family trust with investing in herself, investing in a company, investing in a super fund, self-managed super fund, or a combination of all those, right? So generally people have multiple different tax structures to invest in.
Yeah.
And when we give advice on that, there's got to be a tipping point of cost versus benefit. So if I put it to you, mate, like, who's it for? When would you do it? And when do you pull that trigger?
Yeah, I suppose a way to answer that would be looking at like who's it not for, and the amount of calls I get through our social media of people wanting to set up a trust. Like I had one yesterday, and it was kind of like family, but lower income side of things, wanting to buy a property together through a family trust, and it just made no sense whatsoever in terms of it was three people, no one was earning say more than $100,000 in that situation. There was no asset protection risk. No one was involved in business, and I'll talk about negative gearing in a family trust and how that works. It's very, very different to owning property in your own individual name. But I would say in general to get a benefit from a family trust, I'll say in general you want to have at least someone in the highest tax bracket in Australia. So you've got to be earning over 190 if you're trying to paint a little bit of a picture. Now that's not saying that's a clear cut rule, because by all means, would I have some clients that could benefit from it who are earning less than 190,000 because they're going to invest for 20 to 30 years a good amount of money longer term? Yep. Would a family trust benefit them? Possibly as well. But if we're trying to be a bit more specific here, at least someone in the family group's earning over 190, getting into the highest tax bracket, because then if you're investing through that family trust, you have the ability to distribute the income through to the lower income earner. So I think that's something to note. Business owners, like I said, is generally going to be a bit of a no-brainer depending upon what the business is. Now, if you're just starting out as a sole trader, in trade or whatever it may be, whatever your business is, generally accountants might have you saying, look, just stay as a sole trader for a period of time, which is not then a separate entity or anything like that. So there's no trusts or anything of sorts, because it's very low cost. So you don't need all the complexities. But then as you start scaling up your business, then you convert it into a company and then have that owned through a trust. So most commonly business owners, family trust, high income, but also, complicated families, or you've got, people that you could be distributing through to. Because if you're a single person and you've got no one that you can distribute through to, say you've got a very small family, no spouse, no kids, no one,
Yeah.
having a family trust doesn't do shit for you.
Yeah.
Like who you're going to distribute the income through to? You could have a company as a beneficiary, but that's just going to be tax deferral, because what happens when you distribute to that company, the money has to go back out at some point in time, and then you pay something called top-up tax, which is the difference between the company tax rate and your tax rate, which means you could end up still just paying the same overall amount of tax. So again,
Yeah.
if we're talking of trying to sort of screen out who it's not, single people probably can't benefit a great deal from it unless they're in business, of course, and then lower income earners. But again, I wouldn't say if people are in not in the highest tax bracket, if someone's got 5-6 grand a month to invest and they're going to do that for 20 or 30 years, owning that through a trust may not be a bad idea. If you look at the size of what that investment could turn out to when compounded over a 20-30 year period of time,
Yeah.
maybe not that bad of an idea. So it's very hard to give a clear cut, ideal person who can benefit from a family trust and have that tipping point. But the way I always approach it is like looking at those things, and particularly looking at how much free cash flow does the family have? Like how much money does the family actually have to invest? If we're going to be investing $500 a month, I probably wouldn't think a family trust is
No.
going to be a good idea, because your costs associated, your tax savings, it's not going to outweigh your actual ongoing costs and maintenance of it. But yeah, I don't know, Steve, what about you? Do you have any sort of go-tos in terms of how you look at that for clients in any different of a way?
Yeah, it really case by case. It's suitable for anyone in the right situation. It doesn't mean you have
Yes.
to have a lot of money, because when I set up
Yes.
my family trust, I didn't really have any money.
Exactly.
So, but if I didn't have that set up back then, I'd be in a world of pain right now. So
Hmm.
you sort of got to predict the future. I knew I was going to probably get in the position where I was, going to be a businessman and, do all right for myself. So,
Yeah.
you sort of got to look at the situation case by case, where we're headed, what we're doing, what does the next 2, 3, 5, 10 years look like? Is it suitable? Yes or no? It's really not a. It's hard. It's a hard one, and it takes professional judgment big time. And
Yes.
that's where your good advisor kicks into gear, right? Because you don't want to. If as you said, if it in 5 years' time you've only got a couple hundred grand or something, it's not worth it.
Hmm.
But if it ends up being millions, and let's be honest, it's got to probably be millions of dollars, then it's clearly going to be worth it, right? So yeah, it's case by case basis on that one, mate.
Yeah.
And if we cover off then, where the government sits and the ATO sits with these family trust situations, because it sounds like listeners would be listening and going, hang on a minute, this just sounds like how to dodge the tax. These advisors are just trying to, dodge the Australian tax system,
Yeah,
which we're definitely not trying to do. Let's just clear the air.
call it out. Yep.
But what's the ATO position, the government position on all this stuff, and what's the latest there?
Yeah, well, it's all totally legitimate. Most politicians probably have family trusts themselves as well, and been around a very, very long time. But the thing that people have to watch out for, and where the ATO has been cracking down on, is in the past people had adult beneficiaries, but kids. Let's talk about kids because that's always the big one. Everyone always talks, about distributing through to their kids. When
Yep.
your kid's a minor below age 18, you can't distribute more than $416 without being penalized with some hefty tax. I believe it's $416 approximately there. So when they turn age 18 is like the magic number. And that's when you can start distributing through to them and everyone's eyes light up. And that's why we've done the whole trust. And in the previous years, what people were doing is were distributing money on paper through to the kids. So say the family trust structure has, $200,000 of income through it or whatever it may be. They were distributing it to, say, hubby and wife, and then also looking at distributing it through to those 18-year-old, 19, 20, whatever the adult kids were that were living at home because they're not earning any income. So it's like, wow, I can distribute through to them and pay very much little tax on that amount and not even give them the money either, though. And that was where the issue was, is on paper, the family trusts were distributing income from a tax point of view through to the kids. Parents were getting this amazing tax benefit, but the kids were actually not ever actually receiving any of that money whatsoever. So on paper, it was distributed, but there was actually no money trail going through to those kids. ATO in the last couple of years has really been cracking down on that. And I hear, different stories and things like that from different accountants. Can you still distribute to adult children? Everything of what I know, you definitely can. But you just got to understand how you are doing that and have clear records of, if you've got kids living at home and you're paying for schooling, university, you're buying a car, you're covering all these expenses, you could legitimately still distribute through to your kids as adult beneficiaries. But, if the kid was living out of home, 20-year-old, they've moved out of home, they're renting, they're completely independent. And then on paper, you're distributing, through the family trust to them and you don't pay for any of what they do in their own life. I'd say you've probably got to watch yourself a little bit there. And that's, of course, where your accountant is going to give you some good advice around it. But that's always the one that you got to look out for, is that distribution, and particularly to the adult children. So I know that's not something you have to worry about yet, Steve, but something to think about for the future. And they're always, the ATO is always changing rules, regulations. So that's just, how things sit now. It can always change. They're always going to be tinkering with tax legislation. But I don't know, have you seen any others over the years, Steve, that they've been looking at?
Not really. Look at, every now and then the government focuses on them and then they back off a bit and leave it probably in the too hard basket, to be honest, because it probably is one of those ones. It's like negative gearing, right? It's it's one of those ones that can be very touchy. And then look, Dave, there's always going to be a way to mitigate your taxes in some way, shape, or form. Whether it's family trust or other, we still pay a hell of a lot of tax anyway. So I don't think we're talking material type of stuff, but it definitely makes a difference. It also gives you that level of asset protection as a business owner. I'd say for any business owner out there, it's crucial. Setting up as a sole trader as a business owner, I think it's crazy, and I see it way too many times. And anyone that's out there as a small business owner, if you're set up as a sole trader, don't do it. It's as simple as that. For the sake of either opening up a company or whatever it may be, for the costs of it, don't do it. But mate, that's interesting. So I suppose it comes down to then what happens to the money in the family trust and where does it go? So how does that work? Like where does actually money go, and how do we get it out?
Yeah, and that's where people sometimes get a little bit confused with the trust and where things actually go. But normally, you'll have a trust account, income's going to be flowing into there, and then at the end of the financial year, you're deciding on where that gets distributed through to from a tax perspective. So hubby, wife, any adult kids, a company, or whatever it may be, and the trust has to distribute that income out every year. So the income through the trust doesn't pool up in there; it does have to go out. So the money has to move out of the actual trust entity. But then it's like, what do you do with it? So for me, it might be more investments, buying property. Sure, there's going to, some of that income you might use for leisure and living and all those bits and pieces. But a lot of people with that are taking a lot of their money and maybe reinvesting back through their trust or in their business or whatever it may be. So the money definitely goes out, doesn't stay within the structure, but they're typically what your options are, because you can't leave it sitting in the entity itself. But I wanted to throw back to one thing, Steve, is like, what are things to be cautious of, with trusts? Is there anything that springs to mind there in terms of, like, one I always I give you an example. I've seen a lot as of late, people getting their structuring wrong, and some clients I've seen as of late, if I give you the example, just change a few details, say they're hubby and wife, hubby's in trade, wife's also a director in the company, the trading company, and she's not even she's not doing anything in it, but she's a director in it. So from a risk perspective, not great, because if someone goes after that company and both hubby and wife are in there, there's no protection whatsoever. So I've seen that one a lot, and also the way that the trust structure has actually been sort of set up hasn't necessarily all been right. And ownership of principal place of residence, I think, is always one to talk about just with this topic. Of, typically a lot of business owners won't have their family home in their individual name, and you got to understand, you can transfer between spouse. I did it before I became an owner in Link. Is I transferred the title from joint names with my wife solely into her name, purely from an asset protection point of view. And I see that one very often, that people haven't done that. And all that's meaning is, when if shit ever hit the fan, and for whatever reason no one plans for it, but stuff can go wrong in business, and say it does, and creditors were to come after you, if they can't get it out of the business, they're going after you personally, the
Yeah.
directors. And if that's, us, if you've got assets in your own name, well, it's all up for grabs. And that's why a lot of business owners typically, don't have any assets in their own individual name, because they'll have it through trusts, or they might have it in their spouse's name. But anything to be cautious of there around trust, Steve? Anything that sort of comes to mind?
Nothing, to be honest with you. I deal a lot of them, and just in back the last 10 years of dealing with them, and any major issues, not really. And to be honest, I've never actually had to shut one down.
Hmm.
I've had to shut down a lot of self-managed super funds in my
Yep.
time, but never like a trust. They're always fairly beneficial, pretty easy to run, simple, easy to
Yep.
understand, and you generally get a lot of benefit out of them. And once you got one, most of your investing is through it. Like unless it's a property's only outlier sometimes because of benefits you get from having it in your own name, from a
Mm.
CGT perspective, etc. But other than that, every other asset really you'd be putting into it. So, if you've got a fairly long runway of life and you've got a long way to invest, and
Uh-huh.
we've got another 30, 40 years, right? So, you're going to be sticking a lot of investments in there. So, for the right people, for the right time and the right strategy, there's no real red flags out, I think.
Yeah, well, I'll throw in a couple of things before we close out then, because you touched on property through a trust, and there's some
Yep.
complexities there. So one I always get is, can I own a family home in a trust? Yeah, by all
Yeah.
means, you certainly can, but you have to be aware you lose that main residence tax exemption on the principal place of residence, which everyone usually knows in Australia. You can own your family home, and whatever it goes up by, if it's worth $1 million, and in 5 years later it was worth 10 million, something crazy, you could sell it and pay no capital gains tax whatsoever with that
Yep.
PPR exemption. But you lose that when the asset is owned through a family trust, so you need to be careful of it. Negative gearing as well, that's everyone's favorite word here in Australia. They love losing money on property to save a little bit of tax.
Yeah.
But it doesn't work like that in a trust. That loss is trapped in the actual trust itself. You can't distribute that out to an individual. I get that question so often. So that loss year to year on that property has to stay within the trust. And if you don't have any other income flowing through that trust, it's actually sitting there and can be carried forward to offset any other future income. But yeah, you can't distribute that through to an individual, and therefore you don't get that year to year tax benefit that people generally love. And also getting assets in or out of a trust, you got to be aware of, like, buying, if you have a property and you want to transfer it into a trust, you're going to pay capital gains if it's an investment, and then the trust is also going to pay stamp duty on the acquisition as well. So, I guess what I'm trying to get at there is, you just want to really make sure you get your structuring right from the get go, because I've seen some horrendous structures with people owning things totally in the wrong names, and it's all
Yep.
it's all out there, not protected, and now they want to unwind. Like, I've seen some people with 10 properties all owned incorrectly in terms of structuring, and they're like, "Oh, can I get all those into a trust now?" It's like, yeah, you could, but you probably pay like 500 grand in stamp duty if you want to do that.
Yeah.
So, the costs of getting just some advice up front, get the job done right from the get go, will pay dividends and save a heck of a lot more. into the long term. So those are common ones that I do see people get a little bit mixed up on, and I get those questions absolutely all of the time. So anything there to add, Steve, before we close out?
That's what I was going to say. That's where clearly decking out your next 10 years and what you're trying to do and achieve and goals and is so important with your advisor, because that's what you just said then. That's the planning part that people miss.
Yes.
And they don't plan at the start, and they stuff it up and then try to fix it at the end, and you just cannot fix it at the end. Our system is designed to catch you out like that. So just deck it out from the start. You might need to pay a little bit of money at the front end. Get good advice, accountant, trust, setups, whatever it may be. However, it's going to save you hundreds of thousands of dollars down the back end.
Yeah. And that's why I generally say to clients, I say, look, I can't help anything generally to what you've done, but I can help you fix your life on the way forward. So it's definitely always best to get the advice up front, not just from an advisor, but also other professionals, could be accountants, mortgage brokers, and lawyers, etc. But guys, we're going to wrap it up today. There was obviously a lot that we've covered in there. Family trusts are a very complex topic. So if you have any questions in relation to it, always best to speak to a professional around those things. And if you're getting value out of it, 5 stars on Spotify and Apple helps us out plenty. And if you can't get enough of us, you can keep following us on all of the social media channels, TikTok, LinkedIn, Instagram, etc. Steve also has a newsletter that goes out every week that you can subscribe to. And we've also got another parallel podcast running with our finance team at Link Wealth Group. It's called The Brokers Lounge. You should get on there and take a look at that. That's talking more so everything on the finance side of things. So please do take a look at it. And if you want to chat to any of the advisors in the business, as always, just jump on the website and you can take your pick and book through to have a free 15-minute call. Steve, until next time, mate, I'll see you then.
See you then. Bye.
Catch ya.